Well, hello friends. I have been telling you that I expect pro-cyclical hysteresis in our financial markets from 2025 right since end of 2023. Why was I telling you that? Because I told you in 2024 there are at least 5 dozen countries that are undergoing general elections. Economic data would be massaged, there would be a feel-good factor which would be spread, and the echo chambers of bull markets would start their chants, leading to an artificial rally. But very frankly, like I messaged you approximately a fortnight ago, I was taken by surprise that the pro-cyclicality actually stepped in October of 2024 itself rather than 2025. I expected it to come after the US elections were done and dusted, but hey, markets are meant to surprise. Now, some of my online family members have drawn my attention to the fact that pro-cyclicality is now being discussed in the open domain. And I had also tweeted about it that a lot of people are going to find out the hard way what pro-cyclicality is. I don't think hysteresis is something people have even bothered to find out. Well, let me allay your fears and put them to rest. Just because something has become common knowledge does not mean that the efficacy or the efficiency and impact of that particular phenomena will ease off. It doesn't quite work that way. Why? Because we human beings are creatures of habit, and we tend to be doing exactly what we feel like doing, what we have been doing for a long time, because behavioral science tells us that you do something long enough, it becomes a habit, and you do indulge in a habit for long enough, it becomes your nature, your personality. I don't see people breaking their nature, their personality and behavior patterns all that soon. They will continue to make the same mistakes, and therefore pro-cyclicality will span out exactly as I have told you in these two videos. Now, the fact is that yes, pro-cyclicality is out in the open. People who don't know about it and now discussing it. So is it too late for them? In my humble opinion, yes it is, because the next phase has already started. Now here again, I talk about something that has not been discussed very often. I don't at least see any discourse in the public or private domain. The second step is the Phalanx phenomena. Now, exactly like the pro-cyclicality hypothesis that I used to put up there, and people used to say, what's that? Now, whenever I say I expect a Phalanx phenomena or Phalanx formation in many charts here in the markets, that's exactly what I hear. Here again, we doers of deeds will actually be long and far ahead of the crowds. That is what will be our edge, and that is what will set us apart in 2025. I've been telling you that a whole lot of high frequency traders, algo based traders from the Western countries are going to land up here, put up shop here, just like Jane Street of the US has. And these guys are going to basically dominate the scene. At that point in time, guys who are ahead of the curve have a chance of surviving and possibly even thriving. Otherwise, with the increase in lot sizes and the higher span margins that are coming with it, a rank and file retail trader is going to find the going fairly challenging. Now, what happens in a phalanx formation? I have also learned my lesson. I will not disclose everything about the phalanx at one go. I will obviously, time permitting, record a special video or two, just like these two videos of pro-cyclicality that I recorded. But let me tell you in this video very briefly, there will be fake rallies. Why? Because from what I can see as per our statistical trading model, the IBEX, and the behavioral trading model, the Barracuda, the big guys have not been able to manage to short as much as they wanted to probably. Which is why I'm getting a lot of residual noise. Now, to be able to unload that remaining residual positions, they will have to push the markets higher. So the retail says, okay, the worst is over. Now, let me get back in. And look at the chart that's coming up on your screen. Every time the market has gone down, whether it's 4th of June on election result day, 23rd July, then you have the first week of August, then you have September, and October, my God, has been terrifying. November, from end of October to November, it's one big sea of red candles. To be able to unwind or unload anything, it becomes necessary for the big money to actually pull the markets higher. But do remember that cost of funds will rise. Now, this is something that I have been harping upon for a long time. And unfortunately, if you've still ignored my warnings, my pleadings, please learn about the cost of funds. I'm terribly sorry. It's already too late for you now. So why is cost of funds important? Because once the prices rise and the retail starts to buy, or even if they are not buying, they are nursing their existing long positions, they will have to roll over these long positions. And when the cost of funds are going up, when the cost of carry is going up, you will actually be paying an incremental or a higher monthly fee to keep your positions alive. So even if the price rises too much, don't think you're going to make bread, butter, jam, and chocolates by the truckloads. I would be happy if guys who are trapped at higher levels are even able to break even and get out in the short term. In the long run, yes, but do remember, when I record my videos, I talk to traders, not investors. A lot of you have been asking me, hey Vijay, just like the pro-cyclicality is now being discussed and possibly your posts and your videos have got a lot of people wise, what if the copy-paste guys start talking about the Phalanx itself? Will it actually have that much impact? Let me assure you, I'm not worried at all. The copy-paste phenomena is nothing new. In the internet domain, in the cyber domain, which is now basically come maybe a decade or slightly higher, copy paste has been prevalent even three and a half decades ago. It was a lot more easier to get away with things because there was no trackability, but now it's visceral. Now, I'm a part of many online groups, and I see some of them are absolutely gentlemanly, and some of them are absolutely rampantly copy pasting from people, not giving credit, etc. But does that really change what happens in the market? Not at all. Not at all. Because what changes the market prices are people who are actually going out there and buying and selling. These are doers of deeds like you and me. Will we actually be paying too much importance or assigning a lot of weightage to copy-paste reports? Not really. So don't worry about these things at all. They are going to continue. They are as old as the hills, and they're going to outreach and outlive us even after we are gone. What we should really worry about is the real competition. It's not the public domain that is basically creating a lot of echo chamber like chants, etc. It's not the copy paste guy. It's the guy from overseas. The high frequency traders, the algo desks who are going to dominate over the market landscape because of A, very deep pockets, B, technological edge, and C, a whole lot of capital that will be available at tap even during intradays and their capability to impact prices en masse. These are the guys that you and I need to worry about. If you're going to worry about the innuendos, you're worrying about the wrong things at all. Do not worry about the fringe stuff. Friends, let's get down to the regular aspect of our weekly market video. And on your screen right now is the weekly market roundup. And you can see both the indices have fallen in unison, and there's been no kind of favor into whether one has fallen more than the other. It's almost identical. The US dollar index has surged, and how? We have basically seen the higher dollar index exerting downward pressure on emerging markets, including India. It's also dragged down gold and silver. Crude oil has come down, but natural gas, as it heads towards expiry in the November series, has seen some short covering. The Indian 10-year benchmark bond yield has basically gone up by 5 basis points, and that's not funny. That means bond prices are lower. Now, this is something that I have been telling you. Doers of deeds know that cost of carry is actually rising. So people who are anticipating interest rates to go down very, very sharply, and they're talking about the rate cycle having peaked, etc., etc. I'm sorry, I beg to differ. This is going to be a check writer's market. Check writers will demand and get higher coupon rates, period. Now, whether they get coupon rates as across the board or they are given a lot more gratification obliquely, that time will tell. The NSE lost market capitalization to the extent of a little over 3%, and that is huge. That's noticeable. That means selling was across the board. The MWPL went up routinely, but it was a whole lot more tepid, a whole lot more mild as compared to similar weeks after expiry in the prior months. The American market indices have fallen, and that basically placed headwinds for our markets as well. Friends, I now come to the ratio chart, and this is the Bank Nifty versus the Nifty 50. Just do remember, the reason why I tell you that banking and financial sector stocks are important is because of the weightage. Nothing happens in financial markets without a reason, and the reason is also financial. If you understand the cause and effect theory, you have a head start or an advantage over the guys who don't. I want my online family to basically stay ahead of the crowd. So, banking and financial sector stocks command 32.5% weightage, and whichever way they go, they impact the broader markets, particularly the Nifty. So, like I've been telling you, I want the Bank Nifty versus the Nifty ratio chart to go above 2.30, if not even higher. Now, it attempted to go higher, but eased back and gave all the gains up. So I would watch the ratio chart very, very keenly in the coming week. Friends, I now come to my in-house indicators. I start with the MWPL. In spite of what I hear a lot in many of the online chat rooms that I'm a part of, many people even take the MWPL very lightly, and that's like an understatement. Many even ridicule it. But on this one indicator, which I have made a special video of, which you can view here, depends your span margin. Because above 60% MWPL, your span margin starts to go up due to exposure margin being added in. ELMs go up, and ELMs will go up even higher in the new SEBI market lot regulations, which have been updated of late. And therefore, whether traders will be able to sustain their trades in those counters will depend on the MWPL. And look at the chart on your screen. It's a weekly chart. The expiry of October series saw a fall, a routine fall, but far more sharper at 28.04%. That's the lowest in the 20-week period of 5 expiries that we've seen. Now, there is always a clawback after expiry, and the clawback has also been very, very mild. At 37.61, the second week after expiry, gains have been the smallest. It's the smallest reading, it's the lowest reading in many, many months. That tells you that the retail guy is tired. Don't forget what I showed you, the Nifty chart. How many times has the Nifty come down from 4th of June? Yes, it's gone up, but 10, 15, 20% declines in many stocks. That is not something that a real world trader would want to go through time and again. Friends, I now come to the NSE advanced decline ratio, which basically has come down again. Now, from 1.31 in the prior week, it's come down to 0.49. That means for every 100 losers, there were only 49 gainers. That's not really confidence inspiring. This is a very, very leading indicator, very reliable. It tells you which way the winds are blowing, and it's not really giving me a great deal of comfort. Now, friends, I come to the stock and index futures turnover. Turnover is expectedly lower because this was a shorter week due to a holiday on account of Guru Nanak Jayanti. The coming week is also shorter by 1 day because of elections in Maharashtra. So it's going to be status quo, 4 trading sessions in a week. Monitor the traded volumes in real time. Friends, I now come to the NSE and the Nifty and the Bank Nifty basis. Basis is nothing but the premium or discount enjoyed by the future over spot. And basis in the Bank Nifty has come down very, very sharply. So there's been a risk off in Bank Nifty. Compared to the Bank Nifty, the Nifty's basis has fallen only marginally. Due to short covering at lower levels, the Nifty futures are not really as weak at lower levels as compared to the Bank Nifty. Now, friends, our in-house exclusive indicator, the impetus, and you've been trusting it for 4 years now. It stood the test of time. What is on your screen right now is the fact that both indices fell down, but the impetus reading was sharply higher. Selling was forceful. This is not good news for bulls. Friends, I now come to the lift weight thrust drag index. It's our in-house exclusive indicator, and the lift weight thrust drag index has jumped. It's jumped to a multi-week high. What does it tell you? That even though the Nifty has lost 2.55%, the lift weight thrust drag index going up tells me that there could be a distinct possibility of short covering on declines. Do remember what I told you about the Phalanx, fake rallies, something that will entice the bulls to get in again. And you're going to have a lot of Parma bulls coming out and telling you, I told you so. Now that's something we'll need to be wary about. Friends, our in-house indicators done. I now come to the bond markets, which are very close to my heart. And as you can see the weekly chart on your screen, the 10-year Indian benchmark bond yield is basically showing signs of attempting to bottom. Now, I've been telling you that 6.6 and 6.8, 6.85 is a band that I would watch out for. I would need a clear breakout above these levels before taking a fresh call. I frankly don't think rates are going to come down in a hurry. And as I made a special video here about what you should be doing after Donald Trump's presidency and the return into the White House, I told you that headline coupon rates might go down, which is the prime lending rate. But MCLR, or the cost of funds, is going to go up. So yes, interest rates are going to come down for the depositor as well. But can a borrower borrow at those PLR rates? I don't think that's happening. So it's going to be a cosmetic cut, if at all it comes. This, I repeat, is a check writer's moment. This market now belongs to check writers. Friends, I now come to the Bank Nifty, and what you can see on the daily chart on your screen, that the Bank Nifty, which was in the earlier weeks not yet confirming a head and shoulder formation, has actually now fallen below the neckline, and the head and shoulder formation may be about to get confirmed. Why am I saying about to get confirmed? Because ideally speaking, you should see a sustained close at least 2% below the neckline for a couple of trading sessions before a head and shoulder can be confirmed. And many a times, price bounces above the neckline and then falls. So can that happen? Yes, it can happen. What's the head and shoulder logical target? It's a measuring move. So the potential to go down to 46,000 levels exists. And do remember 32.5% weightage of banking and finance in Nifty. If Bank Nifty falls, it takes the Nifty with itself. Price is below its month-long moving average, which itself is headed downwards. So the pressure remains. The short-term outlook remains negative. Let's take a look at the weekly chart, and what you are seeing is the price remains within its channel but closed below its 25-week exponential moving average, which is a proxy for 6-month-long holding on cost of an average retail investor. And the average guy is now feeling some amount of sweat under his collar. He's getting a little worried. If the price pulls up above the moving average and stays above, maybe you have seen the worst behind you and a technical pullback rally might just occur. But overhead supply is going to hound the retail guy, and the medium-term outlook is likely to remain jittery. Unless the entire selling by trapped bulls is absorbed, which is the overhead supply, I don't think a sustained up move is coming in a hurry. Friends, in the week before last, this index was ranked at number 6 on the most volatile counters list as per statistical beta rankings that I maintain in-house. It rose 2 notches to number 4. Last week, I advocated an estimated range at 53,125 on the upside and 50,000 on the downside. Unfortunately, I missed that downside support by 96 points because the low of the week was 49,904 in the spot segment. So 96 points because of excess volatility and stress in the market. And in the coming week, I expect a range between 51,775 on the upside and 48,575 on the downside. Friends, in addition to this range, please also check out our daily, weekly, and monthly pivots that I update on our free Telegram and WhatsApp channels. The contact coordinates come at the fag end of this video and in the pinned comment below this video. Do connect with us there, please. Friends, I now come to the Nifty 50, which also lost ground last week. And the daily chart on your screen tells you that this index lost on 3 out of 4 trading sessions and it lost 2.55%. The head and shoulder formation was confirmed on the on the Nifty 50, I beg your pardon, far before the head and shoulder got confirmed on the Bank Nifty. Remember, I told you that the logical target of the head and shoulder formation is 23,225. I've been telling you this since 2 or 3 weeks and it's almost there. Not yet, but almost there because the weekly low is 23,484. A little more, the target would be met. Does it mean it stopped falling? I'm not saying that. We'll have to take it play it by the ear and we'll cross that bridge when we come to it. Which is why I update a lot of data on my Telegram and WhatsApp channels, including my social media accounts, so you can get updated on a daily basis. Do remember the earlier chart where I marked the vicious declines in the past and you see how much pressure the retail guy is actually bearing. Bravado can only come from non-market participants because the real doers of deeds are paying all the mark-to-market and the margin calls. So I have been also telling you to keep Hacienda hedges or tail risk hedges, and the list of all the videos that I want you to see is in the pinned comment below and in the description below this video. Please do learn, for those who are watching my video now for the first time, do learn what tail risk hedges or Hacienda hedges are. They can actually be a lifesaver. This is something that real world traders do. Let's now shift to the weekly chart, which shows a clear fall below its 25-week exponential moving average, which is a proxy for the 6-month long holding on cost of an average bull. So now the average retail trader is under pressure and sweaty under the collar. Overhead supply, like I mentioned in the Bank Nifty, will also hound the bulls trapped at higher levels. Now a sustained upthrust is possible only after 25,200 levels are overcome, which would imply that all the selling pressure has been absorbed. But that is a long shot in this short 4-session week. Friends, in the week before last, this index was number 16 on the most volatile counters list based on statistical beta ranking, jumped 5 notches to number 11. Hey, that's not good at all. That's too volatile for an average retail Joe. Cut down the traded exposure, play for larger lots, as I have shown you in this video. You need to scale down your footprint and play safe. And Hacienda hedges again. Last week, I advocated an estimated range between 24,775 on the upside and 23,525 on the downside. Here again, I missed it by 41 points because the low it made was 23,484 against an expected 23,525. But the volatility was excessive. I hope you're going to be able to live with 41 points here and there. In the coming week, I estimate a range between 24,175 on the upside and 22,900 on the downside. In addition to these ranges, please also take care and watch our daily, weekly, and monthly pivots that I share on my social media accounts. You should also watch this video on how to actually use our pivot levels and how you can actually laser precise your trade entry and exit. Do remember, under the new regime of increased lot sizes, you either need to be more precise or you need to be Mr. Moneybags or Miss Moneybags to be able to make mistakes and get away with it. Friends, I now come to the last bit of statistical analysis wherein I gauge the retail risk appetite due to the footprint of the retail guy in the 4 F&O segments. The weekly chart on your screen right now tells me that index futures turnover fell by 1 basis point, which is indicated as a blue line. The stock futures turnover fell by 4 basis points, indicated as a red line. Index options turnover fell by 7 basis points, indicated as a green line. And stock options turnover went up by 11 basis points, indicated as a purple line. Do note how the only gainer were stock options. Options, not futures. Futures demand more money, they are more volatile, they ask mark to market, and therefore, very clearly, I surmise that risk appetite has contracted. The retail guy is scared. Friends, I now come to my trading strategy for the week ahead. Remember, it's a short week. If I was to sum up this trading strategy in the week ahead, I would say same old, whack-a-mole, whack-a-mole. Whack-a-mole is a game where you take a hammer and from a carom board kind of a structure, a small jack-in-the-box comes out, you hit it on the head, it goes down. That's at great deal of fast speed. At the end of the day, how many whack-a-moles you've basically notched up tells you whether you're going to win or not. So it's going to be hitting on the head. Now, what will I hit on the head? I would basically take theta decay in the non-linear option strikes. I've explained to you in this video on Donald Trump's presidentship as to how exactly that strategy works, where there's a skew or a bias towards one particular direction. The market itself tells you what it wants you to do. As long as you're keeping your ears to the ground and listening to the market signals, you should be doing fine. So the whack-a-mole strategy would be on interest rate sensitives and select oil marketing companies, defense, energy, power, logistics, and very, very small amounts in metal mining companies. I'll tell you why. Now, in the commodity space, I expect oil and gas, base metals, and copper, led particularly by copper, are under pressure. Now, that's basically crashed all the hopes that the retail guys have had after listening to a lot of bullish talk, or should I say bull talk? That's a pun, over how copper can go to 1,000, 1,200, 1,500 rupees a kilo from perma bulls. I've been screaming at on my social media accounts, hey, this is a trap. Industrial metals going through a going through a super cycle is a myth. It's not something that should be happening. Now, you would have lost in excess of 250,000 to 275,000 per lot of long positions in copper, and not to count the cost of carry. This is what happens when you get carried away by the noise that permeates in the markets, and that's a learning lesson. So overhead supply in industrial metals will remain, which is why I would like to use a non-linear theta decay strategy in the skewed option at deeply out of money strikes in this segment. Like I said, my exposure is going to be small because volatility is likely to be above average, far, far above average. I would even go to the extent of saying outlier levels. Huge difference. Where bullion is concerned, I still think it's a very, very sound and safe long-term story. Just ignore the short-term noise that you're hearing in the market. Here again, there are a lot of people who only basically function just to give opinions, and that basically distracts a serious trader. If at all, you can rely on your own work and do your own thing. Have your own system-based entry and exit rules that you've made and stick to them. And believe me, your trading P&L, profit and loss account, will improve substantially rather than listening to all the tips and the noise floating around in the public domain. Where bullion is concerned, I think you should stop looking at the price in 2024, maybe even 2025. I would go far to say that, buy and shut bullion for a couple of years and see what really happens. Friends, if I have any more ideas to share, I would very happily do so on my Telegram channel first, foremost, and always, because I can upload a variety of data files like Excel, PDF, graphics, etc., which I can't really do on my WhatsApp channel. So WhatsApp channel remains, but Telegram channel first, foremost, and always, and I'll be happy to share those stories with you. Do connect with me, please. Before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know how my videos are helping you and what else you would want me to do. Hey, don't forget, share my video please with smart, like-minded traders like yourself so I can reach out to a wider audience and spread the cult of knowledge-based trading. I thank you for your patience in staying with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care, stay safe. Bye-bye.